All right, then the CBN governor there, Mr. Laimi Cardoso, reeling out the figures after the meeting and, of course, fundamentals surrounding this decision. I have Group Chief Executive Officer of Cowrie Asset Management Limited, Mr. Johnson Chukwu, who's been standing by for me and, of course, listening to the central bank governor. Let me allow you start. Mr. Johnson Chukwu, what were you expecting? Many thought there was going to be that shift, considering the fact that the central bank showed that in the last meeting, did that, and many thought we're going to continue with that trend. But coming to see the resolution today, the CBN is retaining MPR at 27%. I like your thoughts around this.
Yeah, I had actually predicted that the central bank was going to keep rates at current levels. The reason is this: the factor, the macroeconomic environment that was obtainable when they took that decision 2 months ago had shifted slightly. And I tell you some of those things. We were seeing a consistent decline in inflation rate, which has been sustained. But we also saw improvement in macroeconomic activities, where we saw the GDP grow at 4.23% and last quarter results. But then on the converse, we are seeing resurging pressure on exchange rates. And the simple reason that since Mr. Donald Trump made this announcement with a threat that he could bomb some bandits and the insurgents in the country, it created some level of panic, some level of concerns among foreign portfolio investors. So we've seen the equity market decline, in addition to the pressures associated with the tax regime, the new tax regime that will come into effect in January. Then we've seen Naira instruments depreciate in prices and yield going on. I mean, fixed income instruments. Nigeria Eurobond had witnessed increase in yield. Both the private market that was offered about 2 weeks ago or thereabout, and the secondary market listed Eurobonds. We've seen the FX rate itch northwards. I mean, we've seen Naira depreciate in all the market segments. So these factors we felt will make the central bank to consider to weigh the option of loosening and possibly err on the side of caution, because we felt that at the time when you're having this renewed pressure on exchange rate, then what the central bank can do is to keep rates and watch the macroeconomic environment further.
Let's now look at some of the issues raised, of course, in that very brief speech, but very detailed by the central bank governor. Now, gross external reserves standing at $46.7 billion US. That takes about 10.3 months of imports, a bit of stability around that space. Now, what do you think that also makes, particularly for the stability of our currency, which is something that we've enjoyed for some time now?
Yeah, to look, the increase we saw in the gross reserve, about $3 billion. For me, it can almost be 100% attributed to the Eurobond that the federal government raised about 2 weeks ago when it was created to our position. What actually should give us comfort if we are seeing, as we saw in the first two quarters of this year, material improvement in our balance of payment, positive balance of payment. We saw in the first quarter of this year, positive balance of payment about 5 trillion naira, and the second quarter about 7 trillion naira. In total, we had about 12.6 trillion naira positive balance of trade. So that is the more enduring accretion to your reserve. The aspect that relates to loans, loan rollover, will have. It's for me, it's not the basis for you to thump your chest and say, look, my reserve has increased. So be that as it may, bear in mind that they will also have a maturing Eurobond. And that Eurobond, the Eurobond we issued now that led to that increase of about 46 billion was partly to refinance the maturing Eurobond. So I think that maturing Eurobond will mature in a couple of days, in a few days from now. And that means we are going to see a decline, an adjustment in that reserve back to maybe in the region of 44 or 43 point something billion naira. But having said that, even if you adjust for that, you will still have a reasonable level of cover. What is required is to have 3 months cover of your imports by your reserve. So we have sufficient cover, even if it adjusts for that. But having said that, like I said earlier, what will be of greater interest to me, which I think will apply to everybody who understands how the economy works, is that we continue to build our reserve from improvement in our exports. The CBN government alluded to that the stability in the exchange rate has actually engendered, and the competitive nature of the currency, as he called it, has actually engendered for more non-oil export. That should be where we will focus on.
Again, back to the resolution at that meeting. CRR for commercial banks adjusted to plus 500 and slash 450 basis points. That to me is also a new development. What does it also mean for our commercial banks?
I think what you're talking of that symmetric corridor of plus 50 minus 450.
Yes.
Okay, where you have the standing deposit rate is now plus 50, and the standing facility rate about minus 450. What that means is that if you place money with the central bank, if you borrow from the central bank, you pay, I flipped it, is the standing facility rate at plus 50, which means if you place money with the central bank, you are if you borrow money from the central bank, you're going to borrow at 27 plus 50 basis points, whether it's 27 plus 0.5%, you're going to borrow from the central bank at 27.5%. Whereas if you lend to the central bank, you are going to lend at 22.5% because you're going to lend at MPR minus 4.5%, 450 basis points. So it then means that they want to encourage banks to lend out to the commercial business operators at below the current rate. If the standing deposit rate is 22.5%, it then means that banks will factor in, okay, what is the risk premium I want to take, or I'm ready to accept to lend the private sector operators. They will no longer be lending at the region of 30%. They will just mark up the 22.5% with the risk premium appropriate to the borrower. So you may see that lending rates could drop to the region of 25, 26%. And even if they go to the central bank, assuming they have some shortfall in liquidity, they will only borrow at 27.5%. So I think at the end of the day, the marginal lending rate will be in the region of that 27.5%, which is the rate they will borrow from the central bank if they run out of liquidity.
Now, global outlook is something that is very important, and we must always touch on it. And the CBN governor says trade tensions between United States and, of course, major trading partners may stifle growth. That is also a worry for me. And you talked about that earlier, talking the submission of Donald Trump and the implication and what we even felt as a country. So what do you also make of other global developments and how it was shaping the outlook of the entire market as we move on, particularly monetary decisions like this one?
Well, I think the most imminent or the most talked about global development is the ongoing discussion to arrive at cessation of hostility between Russia and Ukraine.
Yeah.
I understand the European Union had weighed in, and they are kind of paneling together some level of acceptable terms of disarmament or terms of peace. So contrary to what the US came out before, what this means is that if they eventually are able to agree on a ceasefire, what we will see is that we're going to see a return of Russian oil formally, because of course Russia has been in the market, but not formally. The return of the Russian oil into the market, global market, that will depress price of crude. Of course, we're already seeing the market pricing in that. We've seen market price of crude decline the past few days since the US actually made the announcement that they have arrived some terms of engagement with Russia to resolve the war. So when that happens, what we'll see is that you're going to see your export earnings will be affected because still over 70% of export earnings coming from crude oil. I'm not adding up gas and other elements. When you add those one, you go to close to 90%. So that will be affected, and that would affect the rate of accretion to your foreign reserve. On the other side, The US still has trade tension between it and most countries. It still have a lot of trade tension between it and Russia and China. Even at that, there was just a few days ago some resurgence of tension between US and India, because US was accusing India of breaking its sanctions it had imposed on Russia and China. Then it still has issues with its trading partners, Canada, the Western country, the European Union. So those factors, because Donald Trump's trade policies are so unpredictable, it could come up with something that will kind of distort or unravel the international trade market or international goods market. And all those things have direct impact on demand for input materials, the level of production, level of GDP growth. We've seen GDP growth rate decline precipitously in countries like China because of these trade disputes. So another things will have, like I said, we flush into demand for input materials. And for us, it affects the price of crude and possibly affect the demand for crude. And either way, if the other price of crude or demand for crude is affected, if it is affected negatively, it has a direct impact on exchange rate, and our macroeconomic environment, including inflation rate.
14 banks have fully met the recapitalization exercise, and you understand the stability of our banking system is something that is also very important for an economy that is headed towards the $1 trillion. That's according to the present government. But let me ask you what you make of these banks, the process of the recapitalization, and what you expect moving forward.
Well, we've seen the banks, like I said, about 16 banks have complied, about 20-something banks have raised capital in one form or the other. And I expect that no bank will be liquidated because of this capitalization, because banks have scaled down their franchise, and that is their license from national banks to regional banks. So I think that process will continue. I believe that when the banks are through with the recapitalization process, we will have more buoyant banks, and the banks will be in a position to improve lending. Excuse me. Bear in mind that banks will not necessarily lend from their shareholders' funds, but you help them to invest further in infrastructure, branch network of good 18 branch network expansion now mostly virtual. But technological acquisition will be a critical component of what they will do. And the CBN government made admission to the fact that we have Nigerian banks in several other countries, and there's a source of pride. I think most of the banks that have international licenses are likely going to maintain them, and possibly with this capitalization, it will give them the latitude or the resources to expand further, even beyond their current countries of operation.
Still sounds good. Now we're getting into, of course, in a matter of weeks, we'll be in December, and of course we are all talking already about the dirty December and all of this spending that is expected around that time. My question will be in twofold. What do you think, or what impact would that have with regards to inflation? Could we have a spike? Would we still maintain this decline? I'd like you to help us understand that. And that would be on one side with regards to inflation, and also foreign exchange markets. Many will be coming into the country again for the dirty December. Some say there should be an availability of foreign exchange across the board, and that could even make the naira strengthen further. Maybe we'll be looking at 1,300 to $1 before the end of 2025. I like your thoughts around these two issues.
Okay, I will take it from the second part of your question. We expect that there will be improved dollar inflow when dirty December sets in. As Nigerians in diaspora, first of all, starting from Nigerians in diaspora, I have a relation who came in yesterday already for Christmas. As Nigerians in diaspora begin to come in, and as we move towards the festive seasons, we are going to see foreigners who want to enjoy our hospitality industry, our music industry, our entertainment industry. They will come in, they will spend dollar at hotels, they will spend dollar at event places, and they are on consumption. But the key thing is that should ordinarily lead to improvement in supply, and the improvement in supply should lead to some moderation in price. which you refer to exchange rate. So, and that's why the speculation was that the exchange rate could go below 1.400. But I said, unfortunately, there's a counterbalancing factor now with the concern that the U.S. could attack, not necessarily attack Nigeria, could bomb some segments, some sections, some areas in Nigeria. There is some level of tension, and unfortunately, the fact that we're having kidnapping almost on a daily basis or hourly basis is not helping matters. That is reinforcing those concerns. And a lot of foreign portfolio investors would rather err on the side of caution by keeping their investment, even if they're not going to take it out, in dollar positions. And that's why you are seeing depreciation of local currency. I think that will continue unless there is something that materially changes. The amount of money in the hands of foreign portfolio investors who have invested in the economy is multiple times the kind of money that will come in from diaspora and dating December visitors. So the weight is tilted in favor of foreign portfolio investors. So if their tendency now is to hold dollar or exit, then it will neutralize whatever impact that inflows from Nigerians in diaspora and visitors, holiday makers will have. So that takes me to the first part of the question, which is the issue of inflation. I do not think the consumption by these people, local Nigerians in diaspora coming home for Christmas and holiday makers, is strong enough to tilt the commodity prices upwards. I don't think that is the case. What normally you see uptick is things like transportation costs. Fortunately, if you follow my trend of thoughts, we may see a further decline in crude prices, and if that happens, that means the price of refined petroleum products will moderate further. And that is one pressure point that drives up inflation in December. Bear in mind that last December, after the rebasing of the GDP of inflation rates, the MPS came out to say that inflation actually declined in December 2024 instead of moving up. So I think that trend will likely happen because, one, any material increase in inflation will not happen. But I also do not think we should expect a material decline. And that factor we have to bear in mind that the worsening insecurity in not just northern region of the country, of course, Kwara is part of the northern regions of the country, not central. But the heightened level of insecurity will further constrain transportation of food and food items from where they are produced in the northern part of the country. And that could lead to a reversal of the food price decline that dropped about 30% last month. So this will all indicate that there is some level of uncertainty. In summary, I do not think inflation will have a major uptick. If it's going to come, it may come towards as we go into the planting season. But for December, I think we should have an inflation rate that may moderate marginally. That's my position.
Mr. Johnson Chukwu, I must thank you so much, as always. Thanks for your intervention and, of course, making us understand the outcome of this meeting, as always. Do enjoy the rest of your day.
Thank you for having me.
All right, Mr. Johnson Chukwu is GCEO, Cowrie Assets Management Limited. They're breaking it down. Well, let's read